You're doing everything right. You diligently contribute to your 401k with every paycheck. You snag the company match and you watch that balance grow. You think you're building a mountain of wealth for a comfortable retirement. But what if I told you that you are not just building a mountain of wealth, you're also building a tax time bomb? And every dollar you put in is just lighting a longer fuse. That $1 million balance you're dreaming of, it's a bit of a mirage. A huge chunk of it doesn't actually belong to you, it belongs to the IRS, and they are patiently waiting for you to retire so that they can cash in. We are going to pull back the curtain on how this hidden flaw in the 401k system works. And then I will show you a different playbook the wealthy often use for tax free wealth that your financial advisor might not have mentioned. This is not about trashing your 401k, it's about understanding the game and learning the rules to protect your retirement. Let's talk about the 401k. It's the most common retirement tool in America, and its sales pitch is hard to resist. You contribute with pre tax dollars, which lowers your taxable income today, and your money grows tax deferred. It feels like a win win. If you make $80,000 a year and contribute $10,000, you only pay income tax on the $70,000. That's an immediate, tangible benefit. The investments grow for decades untouched by taxes. Sounds perfect, right? But here's the catch, the fine print that gets glossed over. Tax deferred does not mean tax free. All it means is tax later. And later is when you retire. Every single dollar you withdraw from a traditional 401k in retirement is taxed as ordinary income. Your contributions, your employer's match, and all of the growth, all of it gets hit with income tax at whatever the rates are when you decide to retire. Think of it this way, you have a silent partner in your retirement account, the government. For 30 or 40 years, they let you do all the work, and then when you finally cross the finish line into retirement, they show up to claim their share. If you are in a 25% or 30% tax bracket in retirement, a quarter or more of your hard earned money is gone before it even hits your bank account. That $1 million nest egg might only be $700,000 in spendable cash. And it gets worse. The government wants its money on their schedule. This is where required minimum distributions or RMDs come in. Starting at age 73, the IRS forces you to withdraw a certain percentage from your 401k each year, whether you need the money or not. These forced withdrawals create a taxable event which could push you into a higher tax bracket and even make more of your Social Security benefits taxable. You lose control. The tax bomb doesn't just detonate, you are legally required to light the fuse yourself. So, if your retirement savings are guaranteed to be taxed, what's the alternative? Is there a strategy that plays by a different set of tax rules, one that lets you access your money in retirement, potentially tax free? This is where I would like to introduce the Indexed Universal Life Insurance Policy or IUL. Now, when you hear life insurance, you probably think of a death benefit. And IUL has that, but that's only half the story. An IUL is a hybrid tool that combines a death benefit with a cash value account that grows based on the performance of a stock market index like the S&P 500. And here's the game-changing difference. You fund an IUL with after-tax dollars, so there's no upfront tax deduction like a 401k. But in exchange, you can unlock three powerful tax benefits. First, your cash value grows tax deferred. Second, your beneficiaries receive the death benefit completely income tax free. And third, the key to retirement income. You can access your accumulated cash value through policy loans, which are received income tax free. And this isn't a loophole, it's a feature of the tax code that has existed for over a century. A properly structured IUL can function as a source of tax free income for retirement. You are essentially creating your own private tax free pension. Now let's put these two in the ring and compare them on the factors that matter most for retirement. First, retirement income and taxes. This is obviously the main event. As we have covered, every dollar from your 401k is taxable. But an IUL allows for tax free income through policy loans. Let's make this a little real. Imagine two retirees who both need $80,000 a year. The 401k retiree might have to withdraw $100,000 or more just to net $80,000 after taxes. And the IUL retiree can take an $80,000 policy loan and if the policy is set up right, receive the entire $80,000 tax free. This means money in an IUL can have significantly more purchasing power. On top of that, IUL income does not count as provisional income, which helps prevent your social security benefits from becoming taxable, whereas 401k withdrawals often do. A 401k is directly invested in the market. When the market soars, your account can see huge gains. But when the market crashes, like in 2008, your account value can plummet. You take on 100% of the market risk. An IUL works differently. Its growth is linked to a market index, but your money is not directly in the market. This gives you a unique benefit, the 0% floor. If the market has a negative year, you don't lose any of your cash value due to the downturn. Your principal is protected. The trade off is a cap on your earnings. If the index returns 12% but your cap is 10%, your cash value gets a 10% credit. You give up some home run potential for the guarantee that you will never strike out with a loss. It's a strategy of steady accumulation versus high risk, high reward. Your 401k is built for one thing, retirement. Your money is basically locked away until age 59 and a half. Early withdrawals mean a 10% penalty on top of income taxes. And IUL is far more liquid. The cash value is your money and you can generally access it at any time for any reason without penalty. Need a down payment for a house? Starting a business? Helping with college tuition? You can take a policy loan to cover these expenses, making the IUL a multi-purpose financial tool and not just a retirement account. What happens to the money when you pass away? If you leave behind a large 401k, you are leaving your children a tax bill. They will have to pay ordinary income tax on withdrawals from that inherited account. The IUL at its core is life insurance. The death benefit passes to your beneficiaries completely income tax free. $1 million in 401k might become 700,000 to your heirs after taxes, while $1 million in IUL death benefit is a check for $1 million. For legacy planning, the IUL is the clear winner. I know this might make the IUL sound like a perfect financial product. It's not perfect. It's a complex tool that has to be understood and used correctly. First, let's be blunt. IULs have costs, especially in the early years. There are insurance costs, administrative fees, and commissions. And these fees mean that an IUL is a long term play. If you are not committed to funding it for at least 10 years, it's not really the right choice for you. Second, the policy must be structured and funded correctly. If you fund it wrongly or take out excessive loans without letting the policy recover, it could lapse. And a lapsed policy can create a massive tax bill on all the gains you have accessed tax free. This is why it's critical to work with a specialist who knows how to design these policies for maximum cash accumulation. So, who is an IUL for? It's for someone who is already getting their 401k employer match. Never ever turn down free money. It's for individuals who want to save more than the annual 401k contribution limits. And it's for people worried about future tax rates who want to build a bucket of tax free money for retirement. It's for those who value downside protection and are willing to trade some upside for that safety. And finally, it's for people who want to leave a tax free legacy. If you're tired of the idea that your 401k has a hidden tax bill attached, and if having tax free income in retirement sounds like the control and peace of mind you want, then it's time to take the next step. This isn't generic advice, it's a strategy that needs to be tailored to you. Click the link in the description to learn how an IUL could be structured for your specific age, budget, and goals. Honestly, the debate shouldn't be IUL or 401k. For most savvy savers, the answer is IUL and 401k. The smart strategy is to contribute enough to your 401k to get the full employer match. That's an unbeatable return. And after that, instead of pouring all your extra savings into that tax later 401k, consider diverting them into a properly designed maximum funded IUL. This creates tax diversification. In retirement, you will have two buckets of money. One bucket, the 401k, fully taxable, the other, IUL, tax free. And when you have both, you have control. In the years that you want to keep your taxable income low, you can pull from your IUL. And in years where tax rates might be lower, you can pull from your 401k. You get to decide when and how you pay taxes and not the IRS. You have worked far too hard to see 30% or more of your retirement dream wiped out by taxes you didn't see coming. It's your money. It's time you had a strategy that lets you keep it